I want to begin this way by rewinding the tape to February of 2021. Cathie, at the time, your flagship ETF, ARKK, was up 350% from the pandemic low. And cash, as you may recall, was pouring in so quickly, people wondered if you could deploy it all. And Ulrike, Tudor doesn't run ETFs, so I must imagine that your return profile is different than Cathie's, but you're a technology specialist, and so you were enjoying some of the same tailwinds. And since then, as we all know, it has been a bloodbath for investors in innovation. And of course, we think we know why, right? We think it's about inflation, we think it's about the Fed, we think there's some Ukraine in there. But Cathie, I want to start with you because you're often a contrarian and unconventional thinker, and I just gave you the conventional reasons for why what has happened from your perspective. What happened?
Well, I mean, we agreed that if inflation and interest rates took off, that would be a problem for high valuation stocks. But I do think what is happening now, we saw a dry run of it before COVID. So if you remember before COVID, as we realized what a problem we had on our hands, the globe had. I think the markets were down in 1 month's time, 25%. We were down 46%. From those lows, as you just said, we from April 20 to 21, 350, 360%. Since then, just to keep the keep the perspective here, down 75% at our low in May. Now we're probably testing it today as we speak, so we shall see. I think one of the things that has happened is during risk-off periods, we see a rush back into indexes. So a lot of the market's gone passive, but when we move into risk-off, this idea of career risk, business risk surfaces in discussions, and there's a movement back into benchmark stocks. We don't own the big benchmark stocks. Only one of our stocks has made it into the benchmarks, and that's Tesla. And believe it or not, Tesla's held up better than our portfolios, right? So I think there's been a lot of algorithmic trading. I felt it pre-COVID, the variables algorithms focused on cash burn, cash cushion. And yet at the time we were saying, wait a minute, this makes no sense. This is COVID, and we need to solve this problem. Innovation solves problems. And so that was one of the reasons we had that swoosh, right? We were solving problems, global digitalization, figuring out we sequenced the coronavirus and so forth. I think the same thing now. We've had this incredible decline. We have so many more problems now. Supply chain, Russia's invasion of Ukraine. Innovation solves problems, and yet these algorithms and very short-term time horizons. Ours is 5 years. The market in risk-off goes to 1 quarter. Algorithms are dominating the market. It's very interesting. Most people don't know what our companies do. And they don't know the kinds of problems they are solving. But as we've gone through this period, the 75% decline, we've concentrated from 58 names to 33 names, to our highest conviction names. Typically, that's a very good strategy for the turn in the market.
Ulrike, would you agree that this isn't simply a matter of using a different rate to discount future cash flows, and there are flows help to explain what's happened to innovation names, and technicals help to explain what's happened to innovation names, and the arrival, or at least the supercharging of certain kinds of other strategies in the market?
Well, I would say the biggest difference is, as you said, rates. We were in an environment of almost 0 rates, and in that environment, a lot of things get funded. Moonshots, Mars shots, maybe Mercury shots. But when the opportunity cost is no longer 0, that's a very different investment environment, and I think we have to brace ourselves for that. As much as I'm excited about investing into innovation, AI, and data infrastructure, if I actually apply exactly those vast amount of data, like the last 75 years of economic data and machine learning, you come to the conclusion that federal funds rates might have to go to well above 5% to get to the 2% PCE inflation that the Fed is targeting. And then that in turn is the second point, that GDP growth will have to decline next year. So I think we're at the point where the economic cycle and the innovation cycle are turning in opposite directions. And that's very different from the last decade where those two wheels have been turning in unison. The innovation wheel is still turning, that's the good news, but it's going to be throttled by the economic slowdown that we are experiencing.
The prevailing view in the second half of 2020 and early 2021 was that the pandemic had brought the future forward, that the digital economy was on a different trajectory, a trajectory that was independent from the rest of the economy forever. And that the valuations of stocks like Peloton and Zoom and Shopify and CRISPR and Twilio were not extreme, but rather justified. Why, Ulrike, have the things that seemed so right then, that made sense then, turned out to feel so wrong now? Those explanations don't work any longer.
Well, I think, back to the two wheels, I think, the economic cycle has had almost a multiplicative effect on the innovation cycle. And so now we're just in a very different economic climate. And if we look at past stock market corrections, especially rate-induced ones, there are typically two stages. The first stage is where valuations, extreme valuations that we have seen take a hit. We have seen this in the first 2 quarters of this year. The good news is we can check that box. We are through that. But we're just about to enter the second phase where actually the economy is starting to weaken, where we'll see companies miss earnings, negatively pre-announced. We heard FedEx, also AMD last week. So we'll see more of that. And at the same time, we'll still see more multiple contraction going forward because there's more economic uncertainty. So this, unfortunately, is not a straight path down, because often, you see bear market rallies and results are better than feared. And the reason for that is that it just takes time for these rate increases to put their claws on the economy. The half-life is about 2.5 quarters, so we're still seeing the brunt of this economic malaise next year.
Is the core thesis to innovation investing still intact?
Yes, we, like Cathie, have a very long-term horizon in our investments, 5 to 10 years. But my take as an innovation investor right now, there's the short term, is the medium term. So in the short term right now, for me, it's all about hedging. And I know hedge funds tend to get a bad rap because apparently we're so short-termist, but to hedge actually means to protect. And hedging allows us staying power in those companies that we believe have the best growth prospects over the next 5 to 10 years.
Cathie, I'm sorry, keep going.
But I think, there is some really bright light at the end of this tunnel, which is that we will have a once-in-a-decade opportunity, I think, in the next few quarters. Right now we have to be patient, where we will, almost like time traveling back to 2001 and buying Amazon at less than $1 a stock, only that this time around it's going to be the next generation of the FANGs. But for now, prudence, patience, and hedging.
Cathie, this is more of a matter of curiosity for me than anything. You weren't blind to the risk of a correction. In fact, when you and I talked in December of 2020, I remember vividly you saying there's a really good chance that the correction is just around the corner. And of course, it did turn out to be just around the corner. Ulrike just mentioned the importance for her of hedging. Now, you run an ETF or a series of ETFs, and they are, for the most part, fully invested. There's occasionally a little bit of cash in them.
Very little cash.
But very little. I would like to know, and I think people here might like to know, if you were running a different kind of a vehicle, would you be managing it differently? Would you be investing differently? Would you be hedging? Would you be allocating more to cash? Would you be buying protection in the options market?
So so you're asking about the wrapper, separately managed.
Yeah.
Okay, we do run other accounts like that. But we're very clear about what we do and what we don't do. We are not an asset allocator. We are focused exclusively on disruptive innovation, transformative innovation, and I think we're fulfilling an unmet need out there. We are doing research and giving it away to help educate people on how our world is going to transform. And I think the underlying premise in your questions, Ulrike, is that inflation is the problem and might remain the problem. We actually think there are signs all around the world that deflation will be the bigger problem. And as I understand from this conference, I don't think the word deflation has been mentioned here. Mm-hmm. So I kind of like that. If everybody is sure something's happening and you have evidence brewing that that might not be true, those are great calls. Now, I have a macro background. If I were running a macro fund, I think it would have done pretty well this year, but that's not what we do. We do have a point of view, though, on deflation from two angles. Cyclical, in the pipeline, commodity deflation is proliferating, and then downstream at the consumer end, and this is globally, we are being overwhelmed by inventories. So we believe in this holiday season that will become clear. It was interesting to see the online expectations for this holiday season, only 2.5%. That doesn't allow much room for real growth or inflation, right? Something's wrong out there, number one. And then the other thing is innovation, especially the amount of innovation that is evolving today, is inherently deflationary. There are massive deflationary undercurrents. And the base of these new ways of doing things is getting high enough to start moving the needle. So I believe in the next 3 to 6 months, you're going to hear more talk about deflation.
I want to point out one thing, which is that you've been very consistent. In my experience with Cathie, she is consistent. If you go back 10 years, if you go back 12 years, you will have heard her saying many of the same things she's saying today. But specifically on the subject of deflation, you were talking about deflation a year ago. Mm-hmm. Now, it's true, we lived through an awful lot of inflation since then. I'm curious to know why, not just that you believe deflation is important to talk about, but why you've brought this up in a very open way. You wrote an open letter yesterday to the Federal Reserve, speaking to the risk of what you called a policy error. Not the only person, by the way, who's suggested the Fed may be going too far too fast. Why throw it out in the open like that?
We were struck at the unanimity of the vote among the Fed governors. And that tells us that this discussion is not getting out there broadly enough. And so we wanted to raise some points, specifically the commodities I just mentioned, downstream, used car prices. Used car prices were one of the first indications that the supply-demand imbalance was going to become extreme. They went up 54% year over year, tested to 45%. Now they're down year over year. And we think they're actually going to go down a lot more. Why? Because of the shift, the consumer preference shift to electric vehicles. The residual values of gas-powered vehicles, we believe, is going to fall apart. Many people inventoried a car because they did not want to take mass transit. They didn't need that car. Mass transit is back. Now they were looking at prices saying, oh my gosh, I could get a nice profit. Now they'll have an inventory loss. Maybe they won't take it, maybe they'll keep the car. But we think the dealers are going to be in a lot of trouble. They already are. The stock market is telling us.
Ulrike, there are important linkages between economic conditions, the capital markets, and the innovation cycle. Do you worry that the rising cost of capital, demand destruction from monetary policy, and the risk of a recession, if we aren't already in one, will damage the funding model and maybe even the business model for transformative technology?
Yeah, for sure. Very, very briefly to your inflation point, if I may, if we look currently at the composition of PCE inflation, about half of it is demand-driven and half of it is supply-driven. So even now that we are seeing these supply chains loosening up, even if we were to go back to pre-COVID levels from the supply side, we would still get to a PCE about 4%. So I think maybe just also tying this into your point, right now the Fed doesn't seem to have a choice but to go and target the demand side inflation, which means bringing GDP down and raising rates further. So yes, I do think it will impact the cost of capital, will impact what's getting funded. That innovation wheel is slowing. But the question is, there is bright light at the end of the tunnel. Every recession ends, every rate cycle ends, and typically the data shows that 1 to 3 quarters after the peak in rates, we see a bottom in the equity market. So I think what we are going to is transitory and will open up an incredible investing opportunity set into innovation as we are coming out of that.
Be careful. Transitory has become a 4-letter word.
I think history will judge this. Transitory just took a little longer. I'll also make a point that what we have in the Fed is really a Keynesian Fed that does believe that inflation and demand are positively correlated. The history in the 80s, 90s, and the 2000s is that is not true. When growth picks up, productivity picks up, right? And that is a potent anti-inflationary force. The other thing that's going on, and it's been interesting to watch the surprise around the dollar's increase, 25% in the last year. That's another powerful anti-inflationary force. So
in this country, anyway.
In this country, but what the problem in the emerging markets, it's crushing them. Why? I remember, I've been in the business for a while, as most of you know. In the early 80s, the dollar did the same thing in response to monetary policy. And we ended up in the Plaza Accord and the Louvre Accord, where all of the treasury ministers around the world, including our own, decided to sell dollars and buy those other currencies because that dollar increase was becoming deflationary. Why? Dollar-denominated debt, right? As their currencies are falling apart, their ability to service dollar-denominated debt is disappearing. And that's why many of them are going to the IMF. You've got the IMF, the World Bank, and one other organization basically saying, do you understand what's going on out here? The US doesn't. It really doesn't. We are somewhat myopic, and we are the strongest economy in the world, but it's going to come back to bite us if we're not careful.
Ulrike, on Friday, as many here will have noted, the US government imposed a de facto ban on the exports of advanced technology to Chinese buyers. How much of a factor has geopolitics become in the innovation equation?
Yeah, we are headed to a bipolar world where the US and China are battling for global leadership. And for sure, data and AI, which is our investment thesis, maybe there's no surprise because data and AI yield power. And in the geopolitical context, it means industrial and military power. So that announcement did not necessarily come as a surprise. Clearly, in that context, the US has an incentive to slow down the advances in semiconductors in China, to also stall more advanced artificial intelligence. We can talk about the semiconductor sector maybe in a little bit more detail, because I think it's an interesting industry to showcase the geopolitical interdependencies that technology has created. And I think it's going to be a big factor if you think about the next few decades.
Well, where are we in the semi-cycle? On the one hand, some of the EV makers, notably Tesla and Polestar, are still having trouble getting enough chips. But in other parts of the semiconductor industries, I would point to DRAM, we're moving from shortage to glut very, very, very quickly. And in fact, companies, DRAM manufacturers, are talking about supply destruction. So it's a complicated picture, isn't it?
Yeah, it's really complicated. Like you said, there's lots of inventory built in certain parts and memory. Obviously, we have seen the PC data that just came out again overnight. So there are certain parts that are oversupplied right now, and then there are still the golden screws, on the analog side, on the microcontroller side. So it'll take some time, to work out. But clearly, ultimately, when this cycle is over, all of these different components will be in a glut situation. That's how it always works.
I'm curious to know, Cathie, whether there are stocks you won't own now because of this growing China risk.
Well, we won't own Chinese stocks. In the flagship fund, we started pulling them out when Jack Ma was banished in November of 2020, after building up Chinese exposure quite significantly, because we liked the way China had responded both fiscally and monetarily to the COVID crisis. They had not gone crazy, but we've pulled out pretty much. I mean, there's anti-capitalist, policy actions, and I think common prosperity suggests to us in China that any company, now in some of our more specialized funds, we do have very low gross margin companies. High gross margins are not compatible with common prosperity, as we're discerning, and we're looking for companies that that do fit this common prosperity theme. So, logistics, getting goods out to tier 3, tier 4 cities, electric vehicles, getting transportation, especially if they go autonomous. The cost for transportation will be much lower. So, but in terms of the semiconductor side of this, we've watched the league tables for years, and we were watching because of their surveillance economy. AI, they were making more breakthroughs, so we were watching the league tables. But I've been watching China since I was there in 1994, and one of their primary objectives was to become one of the leaders in global semiconductors. There's some DNA reason, I don't know what it is, why they're not there. The closest they've gotten is with AI. In terms of your question about semiconductors generally and our actions, the risk to innovation generally is regulatory and other action sanctions can slow innovation down. Why? We base all of our modeling, our top-down modeling, on something called Wright's Law, which is a relative of Moore's Law, but it's a function of units and unit growth. So if unit growth is going to slow down, then innovation is going to slow down. The other thing I'll say about bringing the industry back here, by some estimates, it'll take $1 trillion at a minimum. We know that Micron just announced a $100 billion plant in New York. That's over 20 years. So it's going to take a very long time to reorient this supply chain.
The X factor in the meantime, Ulrike, is Taiwan. What if China were to invade or simply put an economic blockade around Taiwan? Is that a COVID-like shock, or is that something worse?
Yes, as you said, Taiwan is the choke point in the semiconductor supply chain. Over 90% of leading-edge chips are being manufactured there, and they go into the most powerful processors, whether it's on the server side in the cloud, PCs, mobile devices, and are bought by companies like Apple, NVIDIA, AMD, Qualcomm, and others. So if something were to happen to Taiwan and its boundaries so that they would be fully compromised, the economic impact would probably be pale in comparison to what we have seen with COVID, maybe actually look like a benign cold. We estimate, even though semiconductors are only 30 basis points of US GDP, they are critical to 34% of US gross output. So we estimate that the economic impact could exceed a negative 6% of GDP and also last for a longer period of time. I mean, the COVID crisis was very short-lived. So I think it's a real risk that, to Cathie's point, now countries realize that, companies realize that too. And the incentive here is to start to localize supply chains, and the CHIPS Act is obviously a first step in that direction. But we'll see that over the next years, decades. It's going to take a long time. Ultimately, that's going to be successful. Countries are going to be more resilient. But I think the one thing that happens is that costs are going to go up. And so all these deflationary benefits that we have reaped over these decades of globalization will be reversed.
You're both big believers in the power of innovation and disruptive technology. While we still have a few minutes left here, I'd like to ask you both, irrespective of price, I mean, that's a fantasy land, right? But irrespective of price and irrespective of valuation, what excites you most right now? Cathie?
what excites us most is the convergence between and among technologies. That that means that S-curves are going to be feeding S-curves, and we're going to see some explosive growth opportunities. You asked the question earlier about recession. Toward the end of a bear market and during recessions, our growth is far superior to that of the broad-based indices in terms of revenues and so forth. But some of the convergences, so genomics, so we have the intersection of DNA sequencing, RNA, protein sequencing, plus artificial intelligence, plus CRISPR. We're going to be curing disease. It's already happening, sickle cell disease, beta thalassemia, ATTR, and there are now attempts at diabetes as well, CRISPR therapeutics. Another thing is autonomous mobility. Zero in revenue today. We believe that will scale to 9 to 10 trillion in revenue by 2030. And that's the convergence of robotics. Autonomous vehicles are robots. Energy storage, they will be electric, and artificial intelligence. And in AI in particular, AI is the glue that's causing all of these convergences. Just in the last few weeks, we're seeing text to image and text to 3D. We've got Meta and Google, kind of putting papers out there and open sourcing this world. And the advancements are unbelievable, so that we're going to lower the barriers to entry in the whole gaming world. User-generated content is going to do that as well. But our lives are going to change completely. NFTs, even with blockchain, AI, NFTs, the creator community, our world is going to change in a way much more quickly than I think people now understand.
Ulrike, what are you most excited about?
Yeah, you're probably not going to be surprised. One word, data. So if there's one certainty, I think, in this economic environment, or maybe in life, is that the amount of data is going to grow. And we like to invest in the picks and shovels that translate that data into dollars. So data infrastructure, AI, and also semiconductors. And Cathie, you talked about these platforms, exciting new platforms like genomics, robotics, energy storage, I think you've talked about as well. And like you said, I think AI, data and AI are the foundational layer that are key to the success of all of these platforms. If you think about robotics, the brain of a robot uses sensor data and artificial intelligence to behave optimally. Then we have on the genomics side, that's actually the biggest of big data sets, 40 exabytes of data a year. We need to understand which genome sequences are responsible for diseases. And that's when we can start to think about gene editing. And then finally, energy storage, we need cheaper batteries, more performing, safer batteries. And again, data and AI can help us test different chemistries, their performance, and also see how the energy is going to be distributed within a battery and in between battery packs. So for me, this is the most foundational layer to invest in that then drives innovation that you have laid out.
So if people want to get behind those ideas, what kind of time horizon should they be prepared to invest on? What kind of risk tolerance should they be prepared to have?
Maybe I'll start.
No, you start.
Okay. I think our time horizon is 5 years, and in a risk-averse market, that's not most people's time horizon. However, we believe that most people are most investors, portfolios, asset allocators are truly short innovation unless they're highly involved with the private markets. Because we believe, and just to give some numbers, that innovation, truly disruptive innovation, will scale from 7 trillion in market cap today to 210 trillion by 2030, from less than 10% of the broad-based public equity market to more than 60%. And so if you're short innovation, you're going to be missing some of these unbelievable opportunities.
Ulrike, time horizon, risk tolerance?
Yeah, we have the same time horizon. We probably don't have quite the same risk tolerance, but we do try to be partners to our portfolio companies. We actually shared our bleak economic outlook with our portfolio companies early in the year to try to brace them for this environment. But they can only control so much, and that's their own execution. And I think it's on us as portfolio managers of an innovation portfolio to see how we can insulate that portfolio from macroeconomic conditions or changes in interest rates, which is really something the management teams can't control.
And for my last question, a fishing expedition. Cathie, do you want to see Elon Musk buy Twitter, or are you worried that if he does, it'll be way too much of a distraction for other companies you do care about, like Tesla, for example, and SpaceX?
I am excited to see what he does and how he open sources the whole thing. I think he's going to change the model completely.
And the risks that people cite?
Well, we've watched him, how he's our Renaissance sounds man. You know, SpaceX, boring, Tesla, of course, and you know, I think he's been able to not only multitask, but actually he's doing these things because he wants to protect us from ourselves in terms of the environment, and also wants to prevent censorship in the case of Twitter, and open source and take the bias out. And I love that.
Ulrike, do you have a view on Elon and Twitter?
Well, no, I think he has said that he's not going to decentralize the protocol, but that would be something really exciting to experiment. I think we need a new form of social media. And so who knows? I'm open-minded.